Are you ready?
Ready.
All right, let's go. Kevin here, top 100 financial advisor and best-selling author. We are here to talk about the stock market. We got some pretty interesting news from the Fed. They're open to smaller rate hikes starting as soon as December 2022, which is, well, tomorrow, based on the time that I'm recording this video on November 30th of 2022. Now, this means a lot for the stock market. If you were paying attention to the market today, you saw that this morning things were bad. It was just a continuation of the last few days. Then he starts talking around 1 or 2 p.m. Eastern, and then the market started to rise. In fact, companies like Microsoft and Google were both up close to 5%, which is interesting. Why were tech stocks up? Why was the market really excited about this? And what do you need to know as an investor? These are all things that we are going to talk about here in just a few minutes. All right, so let's start off with interest rate hikes, what they mean. For those who may be new and just have not hit the like and subscribe button or not left a comment yet, this is your opportunity to do so. All right, so we've been talking about interest rates all year long, so this will be brief, but again, we get new people all the time. So the Federal Reserve is in charge of interest rates. They raise or lower interest rates based on how they feel the market and the economy need. Basically, they are looking to reduce demand because inflation is too high. I think we all agree with that. They are saying, look, well, I'm going to make it more expensive for a business to take a loan, more expensive for you to buy a home, and to force you to say, look, sit down, save your money, and just wait until things come back down to a reasonable price. As essentially what this does. When the market is bad, or the economy is bad rather, they cut interest rates to incentivize people to go and buy stuff, right? Homes, cars, all those expensive things, because that does help boost the economy. For example, I think my mortgage interest rate, and I got my house in 2021, August of 2021, and I think our interest rate was like less than 3%. Today, mortgages are like 6% and above. So my payment would be drastically more expensive if I bought the exact same house today at the exact same price, just based on the interest rate. So that's what they're doing with the interest rates. Now, here's the thing. They've been quite aggressive so far this year in raising interest rates. I think the last one was 75 basis points, which means 0.75%. And they've been doing it over and over and over again this year. They're finally saying, look, we may slow it down. It might not be 0.75. Maybe we'll just do 50 basis points, 0.5%. Or maybe they'll do 0.25%. I'm pretty sure it's 0.5, 50 basis points, but again, that's just a guess right now. But the thing is, this does show us that they are concerned and that they are paying attention. Meaning that the concern here, we've talked about this before as well, is that when you raise interest rates too aggressively, you make it too expensive to run a business, you make it too constrictive to buy a home or a car or anything like that, and you push the entire economy into recession. Because it's not, hey, I'm going to wait, it's, well, I'm not going to buy anything at all. And then without anybody buying anything, the economy pretty much collapses. And that's what happened in the 1980s, or really 1970s going into the 80s, because the Fed back then was way too aggressive in raising interest rates. So that's what they're trying to prevent. And them being aware of this and say, look, we're going to slow things down. That's generally seen as a good sign, as we saw today. So that is what is going on. Now, could they also be less aggressive too soon? That could be also true, and that is some concern. We really never know until like January or February whether or not this was the right move, because when you change interest rates, it takes a while for it to kind of go through the entire stock market and go through the entire economy. And really, the economy is what takes the long part. We already saw what happened to the stock market, and within minutes, the market starts to rise. But the economy is the most important thing here. And here are a few things when it comes to the economy. We already know, and this was reported from the Washington Post today, that gas prices are back to where they were before the Russian-Ukraine conflict. That's good. Now, that is not necessarily within the purview of the Fed, but it does help because it gives us more money to save, more money to spend, and kind of brings down inflation as a whole, because gas prices are a component of the inflation number that we see like every month. So that's one thing. The other thing too is the job market has changed. One of the reasons, and I don't really like this reason because I think it benefits people like me and you, but one of the reasons why inflation was high is because we had too many jobs for not that many people, right? Not that much talent. For example, and this was reported from CNBC, there were 2 jobs for every 1 person. And what does that mean? When there are 2 jobs out there and only one of you, you get to negotiate, right? You get to say, oh, this job offered me this job offered me this. I'm gonna need y'all to offer me another 10,000. I need this bigger signing bonus. I need X, Y, and Z. I want, remote work, all these things, right? Well, those two jobs have to fight for each other, have to fight for you, which is great for you, right? But they have to pay more. They have to pay more. That's more inflation for them. This is more expenses for them on their balance sheet. And it makes them look less profitable because they have to spend so much more on talent than what they had to do, let's say 2 or even 3 years ago. That has been an issue. Now, because of these rate hikes, that number has fallen from 2 to 1.7. So now there are 1.7 jobs for every one person in the U.S. Still good, still in our favor, especially when you look historically. So that's a decent thing, but you can start to see things are starting to change, right? We've also seen that the pace of inflation was rising, obviously, very quickly in 2022, but now this started to slow down just a bit. And the speed in which inflation is moving is right back to where it was in the first quarter of 2022. So it has slowed down, but it's still here. Okay, so you want to look at that in totality. It ain't back to where it was in 2019 or anything, but the speed in which it is moving is right back to where it was in the first quarter of 2022. So things are going in the right direction. I'm pretty sure we all want it to be a lot faster. Now, we've got all the explanation out the way. What does it mean for you as an investor? Does this change what we may want to consider investing in and adding to our watch list? Yes and no. Yes and no. Now remember, I've said this before, November through April, best time to invest historically. All the way back to 1950 rather, this is when the market really starts to make its move upward. Now the last 3 or 4 days hasn't been all that great, but today was good. We'll see what happens for the rest of the month of December. Now, with this move, and it's not a guarantee, okay, he was very vague in saying that we are open to not being as aggressive, and it could be as soon as December. That's not a guarantee this is going to start in December. But in either case, this is a decent sign for tech stocks. And again, Microsoft and Alphabet were a sign of that because those were the ones that jumped close to 5% apiece. The problem here is that just because they are going to be less aggressive in raising interest rates doesn't mean they're not going to continue raising interest rates. So if I told you, hey, look, your mortgage payment is going to go up by $100 every single month, and I say, well, hey, you know what, it's going to go up by $50. Well, it's still going up. Okay, so a lot of these tech companies that don't have a lot of cash, we talked about companies that were very heavy in cash yesterday, companies that don't have a whole lot of cash, okay, they're still going to suffer, right? They're still going to pay a higher interest rate. The market may reward them just a bit, but I don't think we have enough information to this point in time. And I would rather wait to see until that happens to start to judge where I should start to invest in tech. Aside from that, everything else still applies. All the healthcare stuff still applies. If you want to invest in oil, that should still do quite well, but you do want to keep an eye on it because, and I think I mentioned this earlier in this video, gas prices are back to where they were before the Russia-Ukraine situation, which is good for gas prices. So I would reevaluate oil. Now, I am not the biggest oil expert. I do have my eye on ExxonMobil just for research purposes. I'm not going to invest in it, but it is something to pay attention to because you've got gas prices falling. That's one thing in the negative column if you're looking to make money from ExxonMobil. But also, this is the time where we start to use more fossil fuels to stay warm, fireplaces, all that kind of stuff. So there are two things on the oil side. Auto repair, still fine. Healthcare, insurance, all that stuff is still going to be fine. But I do think this is a good time to start to create a tech watch list, okay? Just create it. I didn't say invest in anything yet, but time to create it and just pay attention to it. Netflix, we talked about, has really made it up out the grave. Taiwan Semiconductor is something that Warren Buffett has been investing in or just started investing in as TSMC, I think. Y'all double check me on that one if that's the right stock symbol, but Taiwan Semiconductor is the name of the company. You might want to add and just start to do your research now because in a month or two, it might really start to make sense to invest in. For me, and we talked about this yesterday, the Apples and Alphabets of the world, I think, Apple, Alphabet, and Microsoft, those are like forever companies for me. Those obviously make sense to add to your watch list if you're not already investing in those. So tech might be setting the stage for a comeback. I'm not going out there and saying that it is. This is your time to research to choose which one of these is the most healthy, which one of these has the most cash, which one of these is still profitable at a time like this. I think those are going to be the ones that start to shine. But again, it is not a guarantee. So I'm not saying go out and invest in it yet. I am saying start your research process now. Get the jump now to get all the research that you need to do to make an informed decision. And when it's time to jump for it, right? Once we start to see that they're going to slow down rate hikes, once we start to see that some of these companies are going to continue to be profitable or start to be profitable, that will be your sign. So it's not yet, but this is the time to kind of get all that background research together now. All right. The last thing that we'll talk about is this. If you want to become a better investor, understand how to buy, what to buy, and when to sell, then you definitely need to be inside the members only. I went through one of my most recent trades to show you exactly how that whole investing process works and how you can repeat that exact process. But you need all the tools, right? You need all the keys, and that's all inside of our members only group. That link is right here. All right, there's it for me. I'll talk to you later. Bye.